There's something you need to understand before you ever click buy or sell. Trading isn't just about charts, numbers, or patterns. It's a psychological battlefield. What happens in your brain before, during, and after a trade can make or break your success, and most traders never realize they're fighting their own biology more than they're fighting the market. See, trading feels logical on the surface. You analyze, you plan, you execute. But beneath that calm surface, your brain is undergoing massive emotional and hormonal shifts every second. It's processing risk, reward, fear, greed, and uncertainty at the same time. It's flipping between the instincts that once helped humans survive in the wild and the rational part of your mind that's trying to predict financial outcomes in a digital jungle. Every trader enters the market thinking they're here to outsmart others, but what they're really trying to outsmart is their own wiring. The brain wasn't built for high-speed decision-making with real money on the line. It was built for survival, for fight or flight, not for holding positions through volatility. And that's why even the smartest people can lose everything when emotions take control. Understanding what happens in your brain at these three stages, before, during, and after trading, is one of the most powerful advantages you can have. Because trading isn't just about skill, it's about emotional control. You don't master the market until you master yourself. So, let's break down exactly what your brain goes through and why so many traders fall into the same mental traps over and over again. Part 1. Before trading. Before a trader enters a position, the mind enters what psychologists call a pre-reward state. This is the stage where anticipation kicks in. You've done your analysis, you've spotted a setup, and now your brain starts flooding with dopamine, the chemical of motivation and expectation. But here's the tricky part. Dopamine doesn't just make you feel good after winning. It spikes before the reward when you're expecting something exciting to happen. That means even before you make a trade, your brain is already rewarding you for the potential of success, not the reality of it. This creates a dangerous illusion. It convinces you that you're more certain, more skilled, and more in control than you actually are. As dopamine rises, so does confidence, but often, that confidence isn't rational. You start to believe you're due for a win. You begin to overlook risk and focus only on potential gain. The brain's prefrontal cortex, responsible for logic and reasoning, slowly starts to lose dominance, while the limbic system, the emotional center, becomes more active. You might start reanalyzing your chart not to confirm the truth, but to confirm your bias. That's the start of what traders call analysis paralysis, or confirmation bias. You begin to see what you want to see. There's also another layer, cortisol and adrenaline. Even before entering the trade, your body can sense the risk of losing money. Your brain interprets financial risk as a form of threat, almost the same way it interprets physical danger. Your heart rate increases slightly, your breathing becomes shallower, and your focus sharpens. This heightened state can feel powerful, but it's deceptive. It makes you think you're in the zone, when in reality, you're entering a hormonal high that blurs judgment. This is why traders often enter trades earlier than planned or increase position sizes impulsively. They're subconsciously chasing the dopamine high rather than following their plan. And if you've been on a losing streak, the brain shifts gears completely. Instead of chasing reward, it's avoiding pain. The fear of another loss triggers the amygdala, the part of your brain responsible for survival instincts. You hesitate, second guess, or freeze. You're not trading based on logic anymore, you're trading based on trauma. This pre-trade phase is where discipline should matter most, but for most traders, it's where emotion quietly takes over. You convince yourself it's a perfect setup because your brain needs a reason to release that dopamine hit again. The cycle begins before you even click the button. Part 2. During trading. Once you've entered a trade, The brain enters a full-blown war between logic and emotion. At this moment, your prefrontal cortex, the rational, analytical part of your brain, is in direct conflict with your limbic system, the emotional, survival-driven part. The limbic system evolved millions of years before the prefrontal cortex, which means it's far more powerful and deeply wired. When money is at risk, it can override logic instantly. That's why so many traders say, "I knew what I was supposed to do, but I didn't do it." It's not that they forgot, it's that their emotional brain hijacked the steering wheel. As the trade unfolds, your brain becomes hypersensitive to uncertainty. Each candle movement or tick up and down is processed like a potential threat or opportunity. When price moves in your favor, dopamine surges, giving you a wave of euphoria, a small victory that feels addictive. But when the trade goes against you, cortisol spikes, adrenaline floods your bloodstream, and your body enters fight or flight mode. You're not just watching numbers anymore, you're emotionally living through them. Your palms get sweaty, your heart races, and your thoughts become tunnel-focused on one thing: what should I do now? In this state, your perception of time also changes. The brain starts to distort reality. Seconds feel longer, decisions feel heavier, and you start micromanaging your position, even if your plan said to wait. This is why traders break their own rules, not because they lack discipline, but because their brains are wired to avoid pain and seek relief. Cutting a winning trade too early often happens because the brain can't handle the pressure of uncertainty. It wants the relief of locking in a win. Holding on to a losing trade too long is the opposite. The brain can't handle the pain of realizing loss, so it delays the decision, hoping for a reversal. Meanwhile, your prefrontal cortex is desperately trying to keep control, whispering logic like, "Stick to your plan," or "This is just a pullback." But the emotional brain is louder, fueled by hormones and survival instincts. This inner conflict burns mental energy rapidly. That's why trading for long hours is exhausting. Even if you never leave your chair, your brain is burning through glucose at an accelerated rate, the same way it would if you were physically stressed. The more you trade, the more your brain begins to associate certain chart patterns, times, or sounds with specific emotions. Over time, this creates subconscious habits. Your brain starts to anticipate pleasure or pain based on setups, and that anticipation changes how you act. This is why discipline feels easy in theory but hard in practice. You're not just fighting a thought pattern, you're fighting a biochemical feedback loop. The longer the trade runs, the deeper you sink into that loop. And when volatility hits, that's when the real test begins. Your mind is torn between logic, fear, greed, and instinct. At that point, the market isn't your opponent anymore. You are. Part 3. After trading. When the trade ends, whether it's a win or a loss, your brain doesn't just stop. It enters what's called the post-reward evaluation phase. This is where all the emotions, chemicals, and subconscious habits collide to shape your next trading decision. The moment you close a trade, the body begins to recalibrate. Dopamine levels drop. Cortisol begins to fade. Adrenaline drains from your bloodstream. But in the absence of those chemical highs, your brain starts looking for meaning. It asks, was that worth it? What did I do right? What went wrong? If the trade was a win, your brain gets a dopamine spike, and this reinforces the behavior you took to get there, even if that behavior was risky or impulsive. This is where traders unknowingly start to build bad habits. The brain doesn't distinguish between a good trade and a lucky trade. It only remembers the reward. So if you made money breaking your own rules, your brain now connects rule breaking with reward. That's how overconfidence creeps in. You start believing you found a shortcut, when in truth, your emotional brain just got positive feedback for doing something reckless. Over time, this is how traders build hidden patterns of self-sabotage. On the other hand, When a trade ends in a loss, the brain's response is far more intense. Loss triggers the same neural pathways as physical pain. It activates the amygdala, the brain's fear center, and causes a drop in serotonin, the chemical linked to mood and emotional stability. That's why losing doesn't just hurt financially, it hurts psychologically. You feel it in your chest, your gut, your mood. You replay the trade over and over, looking for the moment where it went wrong. This rumination is your brain's way of trying to protect you from future pain, but it can easily become a mental trap. Some traders fall into what psychologists call revenge trading. The brain seeks relief from the pain of loss by chasing the next win, not because it's logical, but because it wants another dopamine hit to cancel out the emotional discomfort. Others shut down completely. They withdraw, lose confidence, and develop fear-based hesitation in their next setups. Both reactions come from the same place: the brain trying to regain emotional balance. Over time, these emotional cycles, the highs of winning, the lows of losing, and the mental noise in between, begin to rewire your brain. Neural pathways associated with risk, anticipation, and reward become stronger. You start to crave trading not just for profit, but for stimulation, and the charts become your emotional roller coaster. Some traders become addicted to that feeling without even realizing it. The brain learns to expect the emotional intensity of trading, and that craving becomes what keeps them glued to the screen even when they know they need a break. But here's the other side: adaptation. The brain is neuroplastic, meaning it changes based on experience. Over time, if you consistently reflect, track your emotions, and focus on disciplined decision-making, your brain can adapt to the chaos. You begin to build what neuroscientists call emotional resilience. The prefrontal cortex, the logical part, becomes stronger in moments of pressure. You learn to feel emotion without acting on it. You start recognizing patterns not just in charts, but in yourself. This is when you move from being a reactive trader to a strategic one. The markets don't change, you do. Every trade leaves a chemical and psychological footprint. What separates the losing traders from the long-term winners isn't who has the best strategy, it's who learns to interpret those footprints honestly. Self-awareness becomes your most powerful edge. When you start reflecting on how you felt during each trade, not just how much you made or lost, your brain slowly rewires itself to crave logic over impulse. You begin to think long-term, and your emotions finally stop controlling the mouse. Finally, how can you train your brain to master trading? At this point, one truth becomes clear. Trading is not just a skill of knowledge, it's a skill of neural mastery. The people who last in the markets aren't the ones who never feel emotion. They're the ones who've trained their brains to process those emotions without panic, denial, or ego. Your brain, just like a muscle, can be conditioned. But to train it, you must first understand what it's doing to you. The goal isn't to eliminate emotion. You can't. You're human. The goal is to use emotion as information. Fear can alert you to real risk. Excitement can signal opportunity or overconfidence. The mastery lies in knowing the difference. Trading is ultimately a mirror. It shows you your mental strengths and weaknesses in real time. When you learn to read that mirror without judgment, you evolve not just as a trader, but as a person. So, before you chase the next setup, take a step back and ask yourself, what state is my brain in? Are you trading from logic or from emotion? Because the market doesn't care how smart you are, it responds to how disciplined you are under pressure. Your biggest competition isn't the trader on the other side of the screen. It's your own mind, your own hormones, your own impulses. Master those, and the market starts to follow. In the end, trading isn't about predicting price, it's about managing yourself. The chart is just a reflection of collective human emotion, and your job is to stay the calmest person in the storm. When your brain learns to do that, When it stops chasing dopamine and starts following discipline, that's when you've truly become a trader. Not because you've won a few trades, but because you've mastered the one thing that matters most: your mind.